Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory aspect of Chapter 9, which is for current liabilities and long-term debt. And specifically, in the last two videos and this video, we were discussing bonds. So let me get to this slide. All right, there's our bonds. Now, before I get started, realize that as I keep going forward, you have to have you have to know the prior knowledge, the prior concepts as we go forward. Meaning, yeah, we're looking at bonds here, and yeah, I could, if you watch the last two videos, you have to kind of really understand, those that underlying concepts of the bonds themselves as I go forward in talking about discounts, and then in future videos the premium. Right? I can't be going back over the same material again and again, because I took a 28-minute video to explain the underlying concepts, and now I have to explain the 28-minute, explain that same 28 minutes and then begin talking about discounts. The video ended up being an hour, and why did I make the last video? So make sure that you understand those underlying concepts before you go forward. If not, call and speak with an instructor who will help you understand them. But you have to have those underlying concepts down, because as we go forward, we're building. This is cumulative knowledge. This is not linear knowledge. We're building one thing on top of another. Also, too, you're going to be, I'm going to be talking about amortization. All right. You learned about amortization when we had discussed intangible assets in previous chapters. So if you don't understand the concepts of amortization, then you need to go back to the previous chapters and go back and learn the theory and the concepts for that. Because again, this is, those ideas, those concepts are being applied here. And if you don't understand amortization, well, maybe you might understand everything as far as bonds is concerned, but if you can't do the amortization right, well, then you're going to get everything wrong. Okay. So, and of course, amortization is, a form of depreciation, right? So, make sure that you have the underlying concepts down, from previous concepts, because I'm only going to just, build and go, build from where we're at. I can't keep on going back over stuff, previous stuff. So with that said, when we're looking at bonds here, let me get my pen. We had talked about, terminology. I said, read the textbook, all right? And then I had talked about bond prices, okay? And how, bonds are sold at face values of 1,000, and the market price at par starts at 100, and if the price goes up to 101, that's selling at a premium. And if the price drops on the secondary market down to 98, that's a discount. Okay. Well, in this video here, so that's issuing bonds at par here. We discussed that. Now, I didn't show the journal entries for it because they're in the textbook. Okay. But as I'm thinking about discussing the discounts here, I think I'm just going to briefly go over those journal entries for issuing bonds at par. But we're going to, in this video, we're going to primarily focus on issuing bonds payable at a discount and how to handle the interest. Okay, and I'm also going to use the example in the book, the numbers from in the textbook. Okay, I could make up numbers and be doing all of the mental math and whatever have you and the gyrations for it, but as I read through as I was looking over the text material, it doesn't go into such detail. Like, for example, in this, since we're going to be talking about discounts, all right, They're not looking at saying, okay, this here was the market price, here's how many bonds, here's how we're going to get the value of the bond itself. They're basically just coming out and saying, okay, we have these bonds, however many they are, and it's at 478,000 is the value of it. Okay, so they're not concerning themselves with how many and figuring out what the price is in order to get the value of the bond. All right. So we'll see that as we go through here. But I'm going to work on a blank page here from now on. But realize that I'm going to be using numbers, and the numbers I'm going to use are from the textbook so that you can a little bit better understand where these numbers are coming from. Because some students, they can look at the numbers and they go, well, how come, like, why is this 478,000? And they don't know where that number comes from. In this textbook, it's a given number, okay? You're not actually doing any of the calculations, but you'll see what I'm getting at here. All right, so I had said I talk about issuing bonds at par. Okay, excuse me. And if you look at the textbook, it says they're issuing $500,000 of bonds, of 8% bonds for 10 years. Okay. Now that 500,000, if it was at par, remember this is each bond is has a face value of 1,000. Okay, so basically what they're actually selling are 500 bonds at a face value of 1,000. That's how they get 500,000. All right, in the textbook. Right. So remember, they're issuing the bond. All right, so they're getting cash. So they're going to debit their cash for 500,000 because that's how much in cash they're getting. And then of course they're crediting bond payable because that's what they owe. All right, they're getting the cash and payable, and they're going to have to pay out 500,000, in the future. Okay, so that's issuing it at par. Now, as far as realize that happens when they issue it on, in this case here, they issued it on April 1st, and they're paying the interest here semi-annually, right, over the 10-year period, which means every 6 months they're on the coupon of the bond, they're going to pay, the 8% interest. Well, since it's semi-annually, well, let's back up and do the math here a little bit. If I have $500,000 of bonds and I'm paying at 8%, that means yearly, that's $40,000 of interest that's going to be paid on those $500,000 in bonds. But because they're paying it semi-annually, all right, they're going, that means twice a year, so we divide by 2, so that means our interest payment is going to be $20,000 per year, all right? So in the text, as far as par is concerned, they're showing that on September 30th, which is 6 months, don't look at the month of, notice that this is 4/1, right? You can't look at 9 minus 4 and say that's 5 months. No, that's April 1st. So all of April to the end of September is 6 months. Draw a timeline and, work that out to see that that's 6 months. You don't just go, April 1st and then say 6 months from now is 10/1 because 4 from 10 is 6. No, it's, notice that date is not the same as that date. This date is 1 day before, okay? So it's September 30th is the 6 month period. And to make the journal entry when they pay out the interest, obviously they credit cash because they have to pay out the cash for the $20,000, and they have to debit something else. Well, what are you going to debit? The interest expense, right? Because that's what we're paying, right? So those are the entries for that you're making on those bonds up to you know, this here. Let me erase just a second here. This here's your initial entry to record the sale of the bond. Then every 6 months you're going to make this entry in order to pay the interest. And then when we get to the end of 10 years, okay, we have to pay back the full 500,000. Okay, so on March 31st of, in this case here, 2024, right, you know, we have to pay back the cash. So we're going to credit our cash for the 500,000, and we have to debit something else. Well, what are we debiting? Bond payable for the 500,000. Okay, to pay it back. Now, notice that what happens here is that this bond payable was a credit, and this bond payable was a debit. So those two, you know, that washes itself out, and our bond payable ends up being zero. Okay, you know, we took in $500,000 in cash, right? And we're paying out $500,000 in cash. So our cash position ends up being zero. And of course, we have the interest expense that, you know, from every 6 months that occurs over the course of the 10 years. Now that might seem like a losing proposition, but realize that we're talking about par here, okay? And also the whole intent of the bond was to get money in order to, quote unquote, build a building, you know, like in the previous example I'd given, the science wing. And from that, by building that building, okay, you know, renovating the science wing and building an extra building, they were able to generate revenue, all right, from the use of the money that they had gotten from floating the bond. Okay, so that's not shown here as to, you know, all of the revenue that they generated over the course of 10 years by being able to borrow that money in that fashion. It's that revenue is definitely greater than how much they were paying for the interest expense. Okay, and so that's why they go about doing that. Right, so these are the journal entries for this. I had said I was going to discuss discounts, but first I thought I would go over the making the journal entries for the par, and it seems like you know, I've already spent 12 minutes just discussing this. So as far as par is concerned, so I'm going to stop the video here and pick up in the next video strictly talking about discounts. Okay, so if you didn't understand something here, rewind the video, watch it again. Okay, and if you still don't understand something, feel free to contact an instructor.